Hi, everybody. Welcome, welcome, welcome. I'm Peggy Beauregard at the Nest Egg Builder, and we are so excited today to have Cortney Jones speaking to us about seller carryback and negotiating. And you realize it doesn't matter what the real estate is, whether it's a commercial property or a single family, or anything else. It might be a gem, even how you negotiate with a seller and ask a seller to carry back. That's what this is all about. So Cortney, thank you very much for coming, and take it away.
It's my pleasure. Thank you all for having me. So I am going to be talking about creative financing today. So hopefully if you're here, that's what you're wanting to listen about. And I'm going to tell you I'm going to go through it rather quickly because I know we have a lot of time at the end for questions, but I've been doing creative financing for since 1992. So I'm on my 33rd year in the business, and it's all I really knew in the beginning. I was young and I was broke and I didn't have any money, and that was what I learned. So it worked, and so I just decided to keep doing it. I didn't see a reason to really change the philosophy and what was working, and I saw a lot of reasons to not do other things just because I like the creative financing aspect of it so much. So just to make sure, I don't know the audience well, so I'm going to just kind of make sure we all understand what creative financing is. Creative financing transactions, oftentimes the seller takes on the role of the lender, either in part or in full. It just depends on the situation, which we'll talk about as we go along. So, in a normal transaction, the buyer will go to the bank and get financing, and the bank will finance that transaction. In this case, instead of the buyer giving that cash or getting that cash from a mortgage company, they're getting that either from the seller, or they're taking over payments or something along those lines to make it a creative financing transaction. Most of the transactions I started with when I was young, 33 years ago, was just no money down type deals, and the types of things that a lot of people think don't exist, but we're still doing them today. So I consider it really anything outside the norm of going to the bank and getting bank financing with 20 to 30% down. There's so many different ways to structure these transactions, and there's such a variety of creative things that you can do that, to me, I just kind of consider it all anything that can be done outside of the norm. So I've bought over 1,000 houses, and I've never gone to the bank for bank financing other than for my own personal residence, but none for my my investment properties. So there's some various forms of creative financing, and some things that you've probably heard talked about are things like buying sub to or buying subject to. That's kind of short for buying subject to the existing financing, and I'll show you that in a moment. Lease options, owner carryback, full owner finance, that's when the owner finances the entire thing, wraparound mortgages, all-inclusive trust deeds, which is basically the same as a wraparound mortgage, land contracts, assumable loans, and novations. These are just some of the various forms of creative financing that are taught out there, and some of the things that are kind of just wandering around in the trainings. A lot of social media posts about them and things like that. So if you've seen them, great. If you're brand new to them, that's okay too. Obviously, you're not going to get a full education on them in this, but at least you should get some exposure to it. The number one question I get all the time, besides where do I go to learn it, is how do I know when to use what? And the funny thing is it's a little bit like untying all this string. It's really one of those things where you sort of just have to start with developing the knowledge of what all those things are, what they mean, and how they work. And then you learn what your seller's problem is. So you talk to them a little bit, have some conversations with them, find out what it is, the situation that they're either in, or they're trying to solve, or they're trying to get out of, depending on the situation. So once you know their problem, then you can find the right solution from that previous slide that solves their problem, but also makes it profitable for you, right? Because we don't want to go into these not being able to make them profitable. And that's one of the things that I really like about creative financing and owner financing deals, is that we can make them profitable, even in a market like this, where with higher interest rates, a property may not cash flow. So we'll talk a little bit about that as well. Some of the benefits to the sellers, and I think this is one of my favorite reasons for liking creative financing. Obviously, early on, my favorite reason was because I could do it with no money down, right? And I didn't have any money. I was 19. And so now I think one of my favorite benefits or reasons for doing it is the seller benefits, because there really is a benefit to the sellers, and I really can solve a lot of the problems that they may have by using some of these options as solutions. So for the seller benefits, they can spread out their capital gains taxes over time. So if it's an investment property, a lot of the properties I go after are tired landlord type properties. So if somebody's owned the property for 10 years, they're a tired landlord, they want to sell it, and they haven't lived in it for 2 of the last 5 years, then they don't get that tax break of just being able to keep that $250,000 cash free. So instead of getting a big chunk with a cash or a tax burden on it, with seller financing, we can at least break that up and take it out into monthly payments. The other benefit to sellers is that if they've been getting a monthly income from the property, then now they can get that same monthly income without the hassle of maintenance taxes or tenants to deal with. So a lot of times that's a huge benefit for them, because they're ready to just, tie it up and say, I'm done. But they kind of like having that monthly check come in every month, which who can blame them, right? They don't have to pay commissions. Obviously, even though I'm a licensed realtor in my case, many of you may be as well. Seller benefits, there's no commissions attached to that. And they can earn passive income on a consistent basis, which is, nice. They don't have to worry about any of that other stuff. And then we can do fast closings. And oftentimes with seller financing, you'll find that you can charge a little bit higher. So if I'm seller financing to somebody else, to a buyer, if the property is worth, say, 200, I can push that usually to about 210, about a 10% or $10,000 range there, because I'm offering financing on it. So it just sort of depends on your market a little bit and how you want to push that. Sometimes you can also create a better spread by charging a higher interest rate. So it sort of just depends on the deal. But those are some of the benefits to sellers, which I think are really important. And a lot of times people don't think of them. They only think of it from me as the investor perspective. Yes, I can get into these deals sometimes with no money down or with not a huge chunk of cash or whatever. But there's also a lot of benefits to the sellers, which I think is important to know and understand. So the next question I get asked all the time is, where do you find people who would be willing to do this? So it's not the average everyday person in the typical hot market, right? If you're an average everyday person, you have a normal everyday house, and you're in a good market or a hot market, then you would sell through a normal channel and get multiple offers and maybe bid that price up a little bit, right? Because you have options. So really what we're looking for here is people who have a lot more flexibility. Typically, they're going to be either motivated sellers, they're going to be knowledgeable sellers, or they're going to be realtors who just happen to know that this is another advantage and another way to sell. So by motivated sellers, what I mean is that these are people who have a different level of motivation than just wanting to sell their house, right? So they might be a tired landlord. They're sick and tired of dealing with everything, and they're elderly oftentimes. And so they're like, like one I had recently, a guy was 72 years old. He's like, I've been listening to these people and their whiny stories for 25 years. I'm sick of it. He was just done. So it's a tired landlord type situation is a huge one. Motivated sellers are also people who've recently filed bankruptcy. A lot of people get into the game of owning rental property thinking it's easy, and then they find out not so much. They didn't plan for any, vacancies or repairs or things like that. So bankruptcy filings and divorce filings are oftentimes a really good motivated seller list. And those are all lists that you can purchase. Foreclosures as well. And then pre-foreclosures or late payment people. So that's kind of some of the more popular motivated seller lists that we use and go after. Knowledgeable sellers, under that category, I would put people like existing landlords, investors who are educated. So people that get on calls like this, who know that it's an option and see that it can be a unique selling proposition that gives them a market advantage. Finance people tend to really like owner financing type things because they know they can make money not only on pushing that price up higher, but then they can also often choose a higher interest rate to finance at, and they can make money that way as well. And then existing private loans who are parties to the transaction. So in other words, you can look up existing loans. So if you look up in the tax records and you see that I'm loaning on other deals, then you might want to approach me to loan on this type of a deal, or see if I have anything else, because you can see that I'm knowledgeable about the type of transaction. So going after people who've already done it or are currently doing it. And then really in our market, at least right now, we're starting to see a lot of realtors get involved in this. Our market started to soften a little bit, and we're starting to look for that competitive advantage. So a lot of realtors are talking to their sellers about, hey, are you in a position, or would you consider selling through owner financing, because that can make your house look that much more appealing to a broader spectrum of buyers who couldn't qualify normally. So investor agents, commercial agents, people who are looking for owner finance type deals, and that type of thing. So that's where you kind of find these type of people. Another really good list is a free and clear owner list, because they obviously don't have a mortgage on the property. They have all the flexibility in the world. So they don't really fall under any of these categories, but because they don't have a mortgage and they own that house free and clear, then it gives them a lot more flexibility, and it gives you a lot more flexibility to find solutions that will work for both of you. And today, the last census numbers came out with 35% of all houses are owned free and clear. So it's a decent sized market for sure. As the market softens, you're going to see more and more opportunities for this, because people are looking for an edge. So sellers that are going through realtors, or sellers that are trying to sell on their own, are offering this as a solution, because they're looking for an edge, and they're looking to be able to move that a little bit faster. And then they want to sell and make passive income. They're seeing the benefits of that. So, it's a viable market. It's something that's been around forever. It's just obviously when the market's super hot and things are selling crazy fast, people don't do it. You just sell and get top dollar. This is one that just recently came to me. This was from a wholesaler. So just to kind of give you an idea of what you'll see, but this one here was like a price. They wanted $15,000 down, and then they were going to carry back the remaining $55,000 at 4.9% for qualified buyers. Now, in this case, they're basically saying qualified buyers. What their level of qualification is, we don't know, right? That's what you have to kind of find out. Sometimes you'll see these for a higher down payment, and they'll say no qualifying necessary. If you're going to put $100,000 down on it, I'm going to trust that you're going to make that payment. And if not, I have the right to foreclose. So you'll see a lot of different varieties of those types of things. That's what's beautiful about it, is that it can completely be as flexible as you want it to be. So just to show you a couple real quick case studies, just to give you an example. So this one here was a seller that we had. He was transferred from Tennessee to New Jersey, and he had like 1 week to move, and he had no equity in his house. He'd owned his house about 6 months. And when he called us to sell it to us, he had no equity, and it was in a rural area of Tennessee where, values just weren't really going up that fast, really maybe 2 to 3% a year. So it was going to be a while before it had any equity. And we really kind of just blew him off and told him that there was really nothing we could do for him. He had seen one of our television commercials advertising that we buy houses. And we told him, there's just not enough equity in there for us to do anything with it. And we kind of blew him off. And then about 2 or 3 days later, he called back and he's like, look, you're the only solution I have. Are you sure there's nothing you could do? And I quickly calculated the numbers out. And I said, I got to be honest, you would have to pay us for us to be able to buy your house. And he said, well, how much would I have to pay you? And I just randomly threw out a number based on what I had just quickly done on the calculator. And so he ended up paying us $32,000 to buy the house. And then we took over his payments of $1,934 a month. The benefit to him was that he was able to move quickly, right? And he didn't have to worry about it. He had the house on the market for a little bit, but it wasn't moving. He didn't even have a showing because, again, he didn't have any equity. So the realtor had basically told him the same thing I told him. If you sell this, you're going to have to come out of pocket. But she had told him he's probably going to have to come out $40,000 to $50,000 and lower the price a little. So I really was his best solution. We took over that loan balance of about $290,000, and then we ended up selling it on owner financing for $349,900 with payments of $2,260. So if you could see there that we made a little bit of a spread on the loan amount. So we took over 290, we sold it for 349. We were making a little bit of spread on the PITI, not as much as I would have liked, but we did get $32,000 up front to buy the house. And then our buyer brought in a $10,000 down payment. So we got basically 3 paydays on that. And then in a couple of years, the people actually did end up refinancing. So we were able to get our full equity out of that, which was really nice. So that's one example. In this example, this one was a divorce situation. And I'm going to move that over there. This one, we took over the payments. Obviously, we took over that loan subject to as well. It says there. We took over the payments of $853 there. It had about $29,000 worth of equity in it. Not a ton of equity, but she was willing to walk away. She just didn't want to have to deal with the ex-husband anymore. He didn't want to have to deal with her anymore. They were basically just done with the house. There was 27 years left on the loan, approximately $200,000. And that one we turned around and sold for $250,000 on a lease option. The monthly payment was $1,150 a month. They have to make, on our lease option contract, they have to make their own repairs. And the person that purchased it put $50,000 down and paid a full year of rent in advance. So all of that was money that went into our pocket. Now, at the end of their year, they actually ended up disappearing, which was an interesting situation. You wouldn't think somebody who puts $50,000 down on a house would just walk away. They had the ability to sell it, and there was some equity in it, but they just disappeared. So we were able to clean up the house and then redo it all over again. And I don't even have those numbers on here, but you'll see these types of situations quite often. It's actually kind of amazing. So some of the things that I love about creative financing is, as I mentioned, we're solving problems while we're benefiting from that as well. So we can solve the seller's problems and get super creative just by simply having conversations with sellers to find out what it is they need, what they're trying to accomplish, and what their trigger is, if you will. We can really provide win-win solutions, and it's totally flexible so that you can fit whatever the property can afford. And what I mean by that is, like, as an example, I've analyzed 3 deals in the last 2 days, and I just couldn't make any of them cash flow with current interest rates. And so it's like, these are decent properties, and they're properties in markets that I would like to own. But with bank financing type solutions, I can't find any that will cash flow that make it worthwhile for me. But if I'm working with a seller and I'm talking to the seller directly, and the seller has flexibility because they have some good equity in the property or they're motivated, then I can work those numbers to make it make sense. So as an example, let's say my payment with bank financing is $3,000 a month, and that won't cash flow. To a seller, I can say, look, at this interest rate with banks and everything, I just can't make this cash flow, but I am interested in owning this property. I would need to get the payment down somewhere to about $2,200 to $2,300 a month in order to be able to make enough cash flow to make it make sense. If I gave you $2,300 a month for the next 30 years, would that be something that would be of interest to you? So you can make those numbers work and then work the numbers backwards from there to figure out, okay, if I'm doing $2,200 a month, what does that look like in payments, interest, and all those types of things, to make sure that, I always say, the property can't afford what the current market is. So it's like, I need to work the numbers to make it look like the property can afford it. There's also a low barrier for entry. You don't need cash, you don't need credit, you just need education. And really, once you understand the concepts of how mortgages are created and promissory notes are created, it's pretty easy to understand most of the concepts. So 1 or 2 books from the library for free, and a person can kind of start doing these because they learn the concepts of how mortgages work and how you can create them. It also gives you a unique selling proposition. Whether you're an agent or an investor, a lot of people don't do this. Some people think it's gimmicky, oh, that's on late night infomercials or whatever. That's not real. There's, a lot of realtors who think that, but the realtors who are smart enough to add this as a tool in their toolbox are able to provide different marketing channels for their clients and sellers that allow different buyers to come in, and it gets them offers a little bit faster. Investors who use this as another tool are able to buy more properties because they're not limited by bank financing or what their balance sheet will allow and those types of things. So it does give them that competitive edge when they have this as a tool in their toolbox. It's totally scalable because I'm not limited by what the bank says I can buy. Oh, you can only have 5 houses a year, or you can only do this much, or because of your, personal financial statement, this is all will loan to you. So in this case, using creative financing, I can buy as many houses as things as I want. I just have to be willing to file through all of the people who wouldn't do it to find the ones who would. And, obviously it's the majority who won't do it, but you're just looking for that small little pile in the haystack, or whatever the word phrase is. I already said no credit or cash required. And you can buy and move quickly, which is really nice. For a lot of people in situations, they're being transferred from Tennessee to New Jersey, they need to move quickly. They don't want to have to keep coming back to deal with this type of thing. So being able to buy quickly is a really good solution for a lot of people, because they need to and a lot of times when they're in foreclosure, they wait till the last minute to do anything. And so it gives you a chance to be able to do things kind of creatively and quickly, which is really nice. So that's a little bit about my creative financing rant. And what questions do you have?
Well, I have questions.
All right, bring it on.
All right. Yeah, you can stop.
Don't ask me any tax questions. I heard that in the beginning.
No, I had a conversation with this. Yeah, can you stop sharing so we can all play together?
Yeah. Where is it here? Oh, there it is. Okay. Perfect.
Okay, great.
Oh, look at you all. You're so gorgeous. And
Isn't this fun? So, well, let's start with
Clarence.
Chuck. Chuck has a question.
Clarence
Clarence
does.
has a question, not Chuck. Sorry, Clarence.
That's all right. I have a question. I have 2 questions. Number
Okay.
1, can you tell me what market you work out of? I think it's Arizona, isn't it?
I physically live in Arizona, but I work several markets.
Okay. And then the other thing I was going to suggest is that if you go back to the first property you presented, if it's still available and those numbers are accurate, there's probably someone on this call that would do that deal.
Oh, I'm sure it's not, because I think that was like a week ago. But yeah, I don't know who. I'll have to look. I was working on the presentation and it happened to come in my email box, and I was like, oh, wow, this is perfect.
Okay, well, there was a huge gap between the down payment and the loan and the ARV. They called it ARVE. What does the E stand for? Do you know? ARVE?
I don't know. My guess is it was probably a typo, but no, I don't know what. I never noticed that, actually.
I suspect that value might have been a typo also, because there would be no creative financing necessary to do that deal in about 5 minutes. Just to share with the group. I don't know if anybody else would be willing to step forward, but that's an easy decision on that deal.
That E might be estimated.
Well, that would be quite an estimate. The
ARV, no, that's an accurate value on that. It's a
600,000.
Okay,
and they only want 15,000 down, and they're going to carry a note for 355.
Yep.
So they're selling a $600,000 property.
No,
for 370,000.
Not exactly. So it won't be a $600,000 property until you put some money into it to make it that. And by the looks of the picture, I would say you're going to probably have to add a bedroom and a bathroom and probably some additional stuff. And then obviously it's probably a full rehab. So you're gonna have to put quite a bit into it, but I get
like 200,000
right there for sure.
Well, you just got to have a roof too. I mean, it had a huge hole in the roof, and all the windows were boarded up, so you might have some broken windows that have to be replaced as well. It looks like it needs a lot of work.
Yeah, it's a full-on rehab, that's for sure. Yeah.
Oh, okay. Well, I guess we could put a 6-story building there and say the ARVs.
Yeah, but in that area, it happens to be our historical downtown area, and so the houses are kind of, and it's probably, I suspect, I mean, again, as like a week ago, it's probably one of those houses where there's a lot of old carvings and things like that. So a rehab is not going to be like a $75,000 rehab. It's going to be more like a $200,000, because you're trying to get all that traditional old stuff that's really popular.
Okay. All right. Well, thank you. Thank you.
Nathan.
Hi, Courtney. All right. I've got a couple of questions, if that's all right.
Knock away. Yeah, for sure.
All right. So one of them you already mentioned, you work in other states. What other states do you work in besides Arizona?
Tennessee, Ohio, Texas, Alabama, Georgia, and right now I'm looking at one in South Carolina.
Okay.
So she's open.
That's
Nathan buys and
great.
sells notes.
I
He'll be on
do.
next week if you want to join us, Courtney.
Exactly.
I buy notes. So that was one of my questions. Do you ever sell these notes once you create?
Yeah, actually I do. It doesn't happen too often because obviously I like that cash flow, and I'm at the point now where I'm trying to slow down a little bit. So I'm creating those types of passive cash flow. But yes, occasionally we do, for sure.
Do you have friends that sell?
Of course.
Excellent. My other question is about servicing. Once you've created this note, do you board that with a servicer, or are you self-servicing? What are you doing for that?
So we self-service them, but it may be something I'll do in the future.
Okay.
I do have a full-time office admin, so that's sort of just always been her job, that she does that. When I first started doing this, there really wasn't a lot of servicing companies that were available to just general, investors like us. They were only available to the big guys. So we just kind of created systems and processes around doing that. And we've always just self-done it. But as I'm moving into my latter years of wanting to deal with all of this, it's definitely something we're looking at.
Do you know what software you use for the servicing, for like tracking the payments?
I have no idea. I think it's just QuickBooks. I don't think she has anything separate. I think she does.
I would, and the big kind of the underlying question under all that is, I just want to make sure that the principal and interest are being separated out in the payments.
Yes, for sure.
Okay.
I have a CPA that's as sticky as all get out.
Oh,
So yeah.
All right. Okay. We'll talk later.
Okay. All right.
All right.
Thanks, Nathan. Jana.
Courtney, you mentioned that you can get some of this education through some books. Do you have some recommendations?
Yeah, I just sent them out the other day to someone. So there's a book called let me think. It's something to the effect of Everything You Ever Wanted to Know About Creative Financing by Riley Wiley is the publisher. That's a really good one. And then Bigger Pockets has a really good creative financing book that you can get on Amazon as well. I think it's Brandon Turner from Bigger Pockets that did that one. That's a very good one as well. And once you read those two, you really kind of know everything there is to know about how mortgages and notes are done, and it gives you some ideas and some specific examples. Once you learn the basics of that, you can apply it anywhere.
Okay, thank you.
Mm-hmm.
Great. Thanks, Jana. Yeah, Nika. I think you're still muted.
Trying to unmute. Okay. So can you talk a little bit more about how it benefits realtors or how they use it? Because don't they just want their commission? I mean, how are they getting their commission if they're turning it over to you?
Yeah.
Because one of your points was that there's no commissions.
Yeah. So, that would be like if I'm buying it from a seller, then I can tell them, hey, you're not going to have to pay commissions if you sell it to me that way. That's what I meant by that. But okay, so how it benefits realtors is a couple ways. First of all, like in our market right now, I know California as well, kind of softening a little bit. Here in Arizona, we're kind of softening a little bit. So when what we had was about 500 houses on the market. Now we have about 5,000. And instead of being sold in an hour and a half, now they're sitting for an average of about 63 days. So realtors are using seller finance type deals to give themselves a competitive edge. If somebody's looking in Chandler for a 3-bedroom, 2-bath house, and there's 2,200 of them to choose from, but there's one that says, hey, you don't have to go to a bank. We'll sell this to you. We'll finance it for you. You just need $10,000 down. Then that makes that one a little bit more appealing. Somehow the floor plan becomes a little bit more less important when they can get favorable financing for that. So a lot of realtors are starting to use that. Well, not a lot, but relatively compared to what was using it before. So we're definitely starting to see a lot more of that in the market. It just gives you another tool to be able to use and offer. So if you had buyers before that couldn't qualify for a loan, maybe for some small reasons, they just need a little bit more time to get their credit in order. we all have those people as realtors that the mortgage broker's been working with to get their credit improved for a period of time. And they'll tell you, hey, it's going to be 3 to 6 more months. We got to do all these things. So all of a sudden now those people are potential people for that house. So you can get those buyers into that house because sellers are a little bit more forgiving with those types of things than banks are. So that's a couple of different ways. Now, how they get paid the commissions is a couple of different things. It depends. So as all real estate questions, right? It depends. I personally, as a realtor, will take commissions back in the form of a note because I'm smart. And so I don't have to get all my money up front, right? I like waking up to having checks in my mailbox. To me, that's the most fun thing in the entire world.
Yeah.
So, right? I don't know that there's anybody on this call that doesn't think that's amazing. So for me, if I'm supposed to be getting a $10,000 commission on that transaction, for instance, and let's say that the transaction doesn't support that for whatever reason, I can talk about some of the reasons, but I would often consider taking that back in the form of a note. So just like a mortgage note, this is going to be a promissory note that's going to be attached to that house, and that person can pay me over time for that. So whatever we work out, if that's going to look like monthly, or it's going to look like, hey, in 6 months, this buyer is going to refinance and get better terms, and then I'm going to get paid, or I'm going to get some of this over the course of time, or whatever. All of that can be negotiated just like the rest of the transaction. So as a realtor, for me, I'm willing to do that. Now, some are not, and I get that. And so then the way that you do it is you make sure that your down payment is going to cover whatever the seller wants, as well as what you need for the realtor. So let's just assume that the seller says, I've got to have at least $10,000. And your realtor commissions are $10,000, then you would just be like down payment, $20,000 plus closing costs. So then they know they've got to be there with at least 20,000. 10's going to go to the seller, 10's going to go to the realtor. Does that make sense?
Great.
Yes.
Yep. Tina.
Courtney, you mentioned that you bought 1,000 properties. Are they typically single family, or do you do commercial, residential, multifamily?
I do commercial and residential, multifamily, and hotels now as well. So yeah, but the first 1,000 were all houses, single family houses. I don't advise that. And it's not something I would do again.
No, that's what I wondered. Okay.
I didn't know any better when I was 19 and started out. I started on a path, a super focused path.
It's a great way to start out.
Yeah.
Did
But
you?
I would think if sorry, I didn't mean to interrupt. I would think that if a commercial or that you're seller financing, you might not want to put a lot of monies into it in case, well, you're buying it. So I guess you do own it. So never mind.
And actually, seller financing is more
That's more on a lease option. If you
popular in
lost it.
commercial than it is in residential, which is interesting. And it's really more common there. Subject to financing actually started with commercial a long time ago, and then it started to find its way into residential. But yeah, it's actually more, most of your commercial sellers kind of understand it's just sort of part of the way that commercial is sold.
I think a lot of that has to do with they are used to getting all that income and they want to keep getting income, right?
Right. Absolutely. That's definitely the best benefit. And if you can do it without any phone calls or toilets or vacancies or any of that stuff to worry about,
Or property taxes or maintenance.
Right.
Yeah.
Anything else, Nika?
No, I'm good.
Anything else, Tina? Okay, I have a question for you.
All right.
Coming from the exchange world, do you ever have to, either as a representative or buying your own, do sellers ever ask for like additional where you would cross collateralize any of your equities?
So I've done it before, but it was used when I bought my first apartment building, and I was trying to do it in a way to put as little cash as possible in. And so I've done it before. I've never had a seller ask me for that I can think of. At least it's not in the top of my brain.
Okay.
But no, I've never had that asked for. I mean, most of the sellers, you're kind of introducing this to them as a concept that they don't know, unless it happens to be an apartment. Like the single family home sellers,
Right.
It's a concept they're not very familiar with. Apartment building owners, oftentimes they are familiar with it. But you're usually introducing it so they don't get too creative on their own. I sometimes will have to say to them, you know, okay, you're asking for $300,000 down on this. I only have, say, $75,000 cash available right now. Would you be willing to let me pledge the equity that I have in this other building as well to protect you? You know, so I'll do things like that. So it's usually something I'm introducing if need be.
Okay, well, yeah, and if you're in the commercial world, they pretty much understand that. Because once again, would they get a cash flow on that?
It
What you
depends on how you
pledged.
structure it, right? So like
Of course.
I always do it based on what the property can afford. So if it's an apartment building and it's 20% vacant, or, you know, or 20% occupied, I might say to them, look, I can't make payments for the first year. Or the first 6 months or whatever. I'm going to need time to do this and this and this and this and get this building performing. So can you go without payments for a little while? And then here's what I can do. You know, so I mean, I've had to do that before, because it's like the building is going to take a year to get back to performing. And that's what's nice about the seller financing is I couldn't do that with a bank. I mean, you can negotiate a little bit, but they're not going to let me go a year without making payments. But the seller will if they can, you know, and they understand. You know, obviously the way I present it oftentimes is, you know, there's a lot of deferred maintenance here. I get it. You know, it's been a lot to take care of. And you know, it's usually when they're elderly and they haven't done a whole lot for a long time and, you know, they're self-managing and that type of thing. And then I'll just say, I'm going to have to get this performing before this building is going to be able to afford any of these payments. So can you give me a 6 to 12 month period before I have to start making any payments?
That's great. And they know they got it in that condition anyway.
Exactly.
Okay, and do you give them some additional equity just to make them feel secured while you're not making those payments?
It depends. If they ask for it, I don't usually
Volunteer it.
I don't
hope
usually
not.
volunteer it. I'm not quite that dumb yet. But I mean, I never want to leave a situation where somebody feels like I've taken advantage of them. So if I feel like if I'm getting a feeling in our conversation, like they're feeling that way a little bit, then I might say, you know what else could I do that would make you feel comfortable? And, you know, or ask some questions just to find out where that hesitancy might be in their mindset and then try to fill that, you know.
Great. That's great. Wow. Come on, guys. Anybody have any more questions? Where'd Clarence go? I'm sure he's filled with them.
Tell me what a
Well-
wraparound mortgage is. I've heard of it, but I'm not real familiar with it.
Yeah, so a wraparound mortgage is, this is where it would be really good if I understood how to use the whiteboard on Zoom. But so basically, let's say that you own an apartment building that I want to buy from you, and you owe $1 million on it right now, but but it's worth, say, $3 million. Okay, and so you want to sell it to me for $3 million. But you don't need any money out of it. Okay. You just want to get rid of this apartment building because you're sick of dealing with it. So you have this $1 million mortgage sitting on it. And then I come in and you would create a new mortgage for $3 million, which wraps around the initial one. Okay. And so I would be making payments to you on that $3 million mortgage. You would then be making the payments on the $1 million mortgage. Okay. So you've got the one mortgage that wraps around the old mortgage. So I'm making payments to you, you're making payments on the old mortgage, and then you get to keep whatever's left over. And
So how do we
that's-
ensure that the seller actually is making their payments on their loan so it doesn't
and
default?
that's the risk with wraparound mortges. And so the
And
way
you have
that
it set
I
up so the
do it-
payment goes in escrow?
yeah,
You can do a servicing company.
You can do it
Yeah.
through a servicing company, which is what I do. Is I'll ask them to use a servicing company. The other thing that you can do is you can get an authorization to release from the seller when you are working with them and you're doing all the paperwork and stuff, is so that you can call the mortgage company and verify. Like we have some that we bought a long time ago that we've had forever before servicing companies. And so about every 2 months, it's just kind of in our calendar to call and check on 123 Elm Street and make sure payments are being made. It's just sort of a check thing we do. And so every 2 months, that's like an hour out of my assistant's day is to sit there and call and confirm all of those and make sure that those underlying payments are being made.
And here's the other part of that. So you now have a $3 million loan and let's say that the underlying loan is at 4%, you're going to charge 7%. You charge 7% on the whole $3 million loan.
Right. Yeah. So then Cliff, you're making 7% on that 2 million, and then you're making that 3% spread on that first million. So you're getting an extra little payment bump there as well.
We love
That's why
wraps.
selling on seller financing is a beautiful thing.
And I'll buy that wrap loan.
Exactly. Right now, we have so many of the mortgages that were like 2 and 3%, even 4% in the last few years. So if I'm buying a house subject to with one of those types of loans or an apartment or something, and then I turn around and sell it on a wrap and I charge 7%, I'm making a good little chunk on that spread.
Well, Courtney, we need more people like you, and Nathan, we definitely need more people like you. So, yeah.
Yes, great.
Yeah.
Tina, your hands up. Do you have another question?
I have another question. When
Spread. I mean, the banks have been the tallest buildings in every downtown and city for years, making a 1 to 2% spread. So if you can, do a 3 to 4% spread, that's beautiful, beautiful, beautiful.
my
Nina.
question to you is, when would you use subject to versus wraparound?
So typically you would use subject to so a wraparound essentially, okay. You would use subject to typically when there's not a lot of other equity. Okay. So you're selling me a building for like that house that, there's not a lot of equity. You're selling me a building for $300,000 and it's worth about 280 to 300,000, maybe 260. So you're not going to be sitting there if you're in a desperate situation and you need to move. You're not going to be nickel and diming me over that small amount of equity. You're just like, can you just take over the payments? I'm out. Okay. So that's when I would buy it sub 2. When I'm selling that, I just had this conversation with a coaching client yesterday. I would personally never sell on subject to. I mean, obviously, knock on wood, barring any unforeseen emergencies in my life. Who knows what will happen, right? But I would never consciously and strategically sell on subject to because of some of the risks we just discussed, right? But I would do it on a wrap. So I would sell on a wrap because then I can sell it at a little bit higher price. I can charge a little bit higher interest, and then the payments are coming to me and I can make sure that they're being paid.
Okay, thank you.
That makes sense?
Yes, makes sense.
So subject to is a great buying strategy, but as an investor, I would never use it as a selling strategy.
Okay.
And the other thing you have to be careful on the subject too is that if the title gets changed and you didn't get approval from the bank, then it could be called.
Yeah, it seems
That's another risk you take.
that one just seems very risky. So that's why I asked the question.
It's definitely something that has happened. It's never happened to me after over 600 sub 2 transactions. Knock on wood. I've never had a subject to transaction called due. I do know of a couple people who have, but they were also behind on payments or they did things a little, like borderline gray area.
Yeah, there's ways to work with that, and one of the ways is to write the bank and let them know that you are the new property management company, and that the payments will now be coming from a servicing company, and you just kind of push it off to where the bank's comfortable that they're going to get their payment.
Mm-hmm. Okay, thank you.
You're welcome.
Clarence, thank you.
Yes, it doesn't sound like you typically need money for your deals as you are, taking them over. But you mentioned apartment buildings and whatnot, and I was going to suggest if you did come across a deal that you needed money, bring it back to Peggy's group, and maybe you can syndicate it through the group.
Okay, I will do that. I'll add that to my list.
Thanks, Clarence.
You're welcome.
You like that?
I might be one of the investors.
Is there a specific, like, are you guys looking for a certain number of units and above, or?
We raise capital for everybody, so we're open.
The numbers make sense.
Clarence is always looking.
Okay.
Hey, Fred. How you doing?
Good, Peggy. How are you?
Great.
Courtney, I find this really interesting. Thanks for presenting today.
You're welcome.
I was just wondering, do you ever come across situations where you have a seller who wants to do, sell a property using seller financing, but wants to take it back under a leaseback arrangement? You ever have that in either commercial or in multifamily
Yeah, in fact,
situations?
it's really interesting. We've seen a bunch of them lately, which is kind of strange. They seem to come in waves. It's definitely a situation we see occasionally. When I first started learning subject to way back in like 2000, I was always told and taught never to do leasebacks with owners, particularly anyone over the age of 50, because it was something where the courts were at the time kind of finding where people were taking advantage and equity stripping and that kind of thing. And so I just sort of stayed away from it. What I've seen a lot of lately, especially with houses, is people just wanting to stay because they have other things going on. So I'm open to usually a short-term lease back type situation, but not something long-term. And a lot of it is like the people I deal with oftentimes that we're buying properties subject to from are in foreclosure situations. So if you couldn't afford it then, you're certainly not going to be able to afford it after I take it over because the payment's going to be higher, right? So it just depends on the situation. But yes, I do run across it. Not that often, but every now and then.
So actually in the commercial world, that's done every day of the week. And the reason is because a lot of owners don't know this when they buy the building to run their business, is they can't write off the building. They can't write off the payments.
Right.
It's a mortgage, right? They get to write off the interest. So they sell the property and they lease back because then they can write the entire thing off. So
and they can stay there and keep their whatever doctor
right.
practice there.
So in the commercial world, that's an everyday thing so that they get so it's done for taxes. I know you don't like to talk about taxes particularly, but it's a tax strategy. And a really smart people will actually have their LLC buy the building and the land, and their other LLC runs the company. So they get all the tax benefits, but not everybody knows how to do that. More, Fred?
No, that was it. Thank you.
Okay, Tina?
I have one more question. What are your requirements when you're looking for your list?
When I'm looking for my lists,
Mm-hmm.
you mean like the motivated seller type list?
Yes.
It honestly just depends on what I'm focusing on and what I'm trying to buy. So as an example, if I like right now, one of the key lists I'm going after is subject to newer constructions. So in that case, what my list is looking for is I'm looking for divorces, people who are in foreclosure or who filed bankruptcy, who own a home less than 4 years, and in certain areas. And the reason for that is because if they own it less than 4 years, they likely have little to no equity. I mean, here in the market, we've had incredible booms for the last few years, but we're starting to come down a little bit. So there's equity, but there's not a ton of amount. And then it's newer construction. So it's not like I have to go in and do tons of rehab or anything like that. So that would be a list that so it's sort of your list has to match whatever your buying parameters are and what you're looking to do. So that would be a list that we're using right now. So it depends on what I want to buy.
And if you're doing multifamily?
So multifamily, it would be right now in the markets that I'm interested in, all the ones I mentioned, and it would be 15 and above units. And I usually look for owners that have owned the property at least 10 years because it gives them a lot more equity. And then there's a little bit more flexibility in that.
Thank you.
Mm-hmm.
Great, thank you. Elijah?
Hey, sorry, I'm trying to figure out how to unmute this.
Okay.
How are you guys doing?
Great.
Good. Hey, so I may have missed this. It may have been said already. I was just curious, what are your primary routes of marketing to people? Like, do you cold call or pay-per-click or primarily wholesalers, or what's your primary route to get deals from?
So it's changed drastically over 33 years. In the beginning, it was mostly through realtors. And then for about a 12-year period there, we did every marketing aspect you could imagine: direct mail, TV commercials, radio commercials, signs, wholesalers, everything. In the last 10 years, it's been primarily text cold calling and some direct mail as a follow-up. And then now I'm kind of starting to slow things down a little bit. And so I'm not really doing a whole lot of marketing. It's mostly coming from referral and JV deals. I coach clients all across the country. So a lot of times I'll JV on deals with them, and deals come to me through those types of things. So it's more that type of a connection now. So it's kind of changed throughout my life. It just depends on at what business model we're doing and at what stage we're at in our lives. Like there was a period of time when we were doing 6 to 12 houses a month. And then there was a period of time when I didn't do any rehabs because my daughter was in school and she was traveling a lot with her volleyball team. And I was finding it too stressful to manage rehabs being out of the city every other weekend. And so, that's what I like about this business, right? It's totally flexible. We can kind of change it up and do things. If I'm going to go to Valencia, Spain for the summer, and I am, then I can stop marketing or doing anything so that I don't have to deal with stuff when I'm there. I can just focus on being there and all that. So it kind of just depends on what I'm trying to market to and what I'm trying to buy and how many places I want to buy. But I've tried them all over time.
Does that help, Elijah?
Yeah, that's great. Thanks, Courtney.
Hey, Clarence.
Hi, I have 3 questions.
Clarence, have you not used up your questions yet? I'm seeing a tick mark down here. I think you've.
No, Clarence never runs out of questions, Courtney.
Well, I run out when you don't want to answer.
No, you're all good. I'm just teasing.
I'll second that.
Listen, I was wondering what markets you like for multifamily.
So I'll say all the landlord friendly states. So I like Tennessee is probably my favorite. Tennessee, South Carolina, Texas, Arizona. Actually, Arizona isn't great cash flow. It's decent cash flow, but we have incredible appreciation. And so it makes it worthwhile to do here. I'd say those are probably my favorites.
Okay, thanks. Next question. How are the hotels going?
Really good. Yeah, very good. So we're getting, so we do, what's the word I'm looking for?
Boutique.
No, it's like, you would think, right?
Workforce.
I should have
Extended stay.
Yeah, extended stay. Thank you. We do extended hotels. And so, it's a little bit different of a clientele than what I'm used to, but yeah, it's been going quite well, actually.
Okay.
Are you seeing any of those? Are you trying to get any kind of contracts with the cities to put in like transitional or permanent supportive housing?
Yep. In fact, we have that. Yep. On 2 of the hotels. Yep.
Excellent.
Come on, Clarence.
Are you part of a company, or is it your company, or it sounds like it'd be more than a 1-person show.
So it used to be about a 20-person show, but about 10 years ago, I decided to retire. And so it became a less of a person show. And then about 14 days later, I said, oh gosh, retirement sucks. This is boring. What am I going to do? And so it started becoming a more person show, and I started hiring again. I've been doing this a long time and I get burned out on it and I go through spurts. Right now, it's kind of, yes, I have my own company, but I also partner with others. So I might have different companies set up at different times with different JVs and stuff. I do most of this myself. I have a team of agents. So I have 10 agents that I coach, train, and support and do work with. And then I coach and train investors across the country. So a lot of, like I said, deals that I do with them. So they're kind of like a teammate. And then I also will set up companies with individual, like say, for instance, you and I were buying an apartment together. Obviously, we would set up some sort of a entity to make that happen.
Okay, thank you. We are at the top of the hour and you were the last question, Cliff.
When you're pulling your list, what's the best tool that you have found to pull a good list?
A VA.
Not the tool, a tool.
Great tool.
Yeah, I think she just told me honestly about a month ago that she was switching to a different list company, and I said, okay, I literally don't care. As long as we're getting good data, I don't care. I think I don't even know what she's using right now. I know she told me, and I don't know what it is, and I wouldn't have it handy, but yeah, my VA does all of that for me. And over the years we've changed. I know there's a lot of tools like Property Radar and PropStream and all those that people are using. We just buy our own lists. It's cheaper, and I have access to MLS, so I don't really need the data that people buy in those. And I just have somebody else do it. I don't even know if I could pull a list on my own today. I think it's been so long. I think I'd get on there and just be like, I don't know where to start.
I have a couple lists somewhere listed. I don't use them.
Yeah, I have we have a list guy, and she talks to him, and that's what they do. I don't know. They figure it out.
That's hilarious. List Source is another name, but I have heard some bad.
That's who we used to use, actually.
It's picked over.
Just
yeah, that's what I'm saying. Yeah.
She told me she was going to change, but that's who we used for probably 10 years.
Yeah.
What about using like just having good contacts with title companies? They sometimes can give you that they give you access. They give you like you can log in on your own.
Yeah,
I had somebody give me that.
I recommend a lot of my new coaching clients especially when they come on and they're dead broke and they don't have any ability to be able to buy lists or anything like that. Most of the title companies can get a lot of the lists for you. There's a lot of them they can't get, but they can at least get enough to get you started.
That's right. Title companies are great. Just have to work with them. Mm-hmm. Cortney, this has just been an amazing time having you here. What you're fabulous. I can't tell you. You're right, spot on for everything, and your experience has given everybody a real hope of moving forward in whatever their goals are. So thank you very much for coming, and we'd love to have you come back again sometime.
My pleasure, anytime. And if I can be of help to anybody, let me know.
Thank you.
All right. Thank you all.